expense and interest revenue. You have homework problems just like these. As a matter of fact, I took them from your homework problems, so you should find these problems that I work on to be somewhat useful. Okay? So the first problem we're going to work on is bad debt expense. So it tells us during the year ended December 31st, Kelly Camera Shop had sales of $180,000, of which $90,000 was on credit. And at the start of 2015, accounts receivable showed a $12,000 debit balance, and allowance for doubtful accounts showed a $620 credit balance. Collections of accounts receivable during 2015 amounted to $70,000. So this happened during 2015 on December 10th. A customer balance of $1,600 from a prior year was determined to be uncollectible, so it was written off. And then on December 31st, a decision was made to continue the accounting policy of basing estimated bad debt losses on 2% of credit sales for the year. Okay? So the question asks us to give the required journal entries for the two events in December and to show how the amounts related to accounts receivable and bad debt expense will be reported on the balance sheet and income statement for 2015. Okay? So the journal entry. The journal entry for December 10th, the $1,600 write-off, is just a debit to allowance for doubtful accounts for $1,600, and then a credit to accounts receivable for $1,600. With the balance of $1,600, and we're going to write it off, it's just a debit for allowance for doubtful accounts and a credit to accounts receivable. Okay. Next journal entry. December 31st, a decision was made to continue accounting policy of basing estimated bad debt losses on 2% of credit sales for the year. So we're going to multiply 2% times the percentage of credit sales. If you go back, you can go see. Okay. We had $90,000 of sales on credit. So if you go look at the journal entries, that's first. Okay. We do a bad debt expense debit for $1,800 and an allowance for doubtful accounts credit of $1,800. Bad debt expense is just calculated by doing credit sales times 2%. Okay, so 90,000 times 0.02, it comes out to be $1,800. Okay. So these are the balance sheet calculations that we're going to have to do. We're going to have to account accounts receivable, the allowance for doubtful accounts balance, and the account receivable net of allowance. Okay, your accounts receivable balance, you begin with the beginning balance, you add your sales on credit, you take away your collections and any write-off. So we started off with a $12,000 balance, we sold $90,000 on credit, we collected $70,000, and we wrote off $1,600. So our total is $30,400. Our allowance for doubtful accounts began with $620 credit balance, and then we're going to add in the uncollectible credit sales of $1,800, and we're going to subtract the $1,600 write-off. So that gives us a credit balance of $820. The accounts receivable net of allowance is the difference between your accounts receivable and your allowance account. So we're just going to subtract $30,400 minus $820, and that's what we do here. Okay. And if you see a partial balance sheet, it should look like this. Okay. And the income statement accounts we're going to look at is bad debt expense. That's the only account we have to worry about, and it's just the total bad debt expense recorded. So we go back and look at our journal entries, see how much we recorded, and for that it was $1,800 debit for bad debt expense. Okay. Any questions? All right, I'm going to continue on to interest revenue. Okay. Rec Room Equipment Company received a $9,000 6-month 7% note to settle a $9,000 unpaid balance owed by a customer. The note was accepted by Rec Room on November 1st, causing the company to increase its number receivable and decrease its account receivable. Rec Room adjusted its record for interest earned to its December 31st year end. They received the interest on the note's maturity date, and they also received the principal on the note's maturity date. Okay. So the problem asks us to journalize the transaction for workroom equipment. Okay? So the first transaction we're going to journalize is the note accepted. When the note is accepted, we accepted it to replace an account receivable. So we are going to debit notes receivable, and we're going to credit accounts receivable because we're taking out an account receivable and replacing it with a note. Okay. Then at December 31st, we have to make an adjusting entry for the amount of interest that was earned during this period. So December 31st, the amount of interest earned is your principal times rate times time. You let them borrow $9,000 and it's 7%. And the amount of time is 2 months out of 12 in a year. So your percentage given to you as an annual rate. And that comes out to 105. Okay. The receipt of the interest at maturity. The receipt of the interest at maturity includes this adjusting entry, this amount of interest receivable, plus the amount that was earned over the next 4 months. Okay. So on April 30th, we received cash. The total amount of cash we received for the interest, $315. Of that $315, we said 105 was already owed. That was we just recorded, and then 210 was earned during the period from January 1st until April 30th. So you can see the calculation. Interest revenue is principal times rate times time is 9,000 times the 7% times 4 months out of 12 this time because we went from January 1st until April 30th. Okay. And finally, record the receipt of the principal. Record the receipt of the principal is accepting the money, the cash, $9,000 in exchange for terminating the note receivable. Okay. And that is it. End of the slideshow. If there are any questions, I'll be here and I'm happy to help. Otherwise, if you want to stop by the Learning Commons, come by and see me. I'll be happy to answer any questions you might have, and bad debt expense, interest revenue, and whatever else you might be working on in your bank right now. Thank you, and have a good day.